Stock A trades at $25. Stock B trades at 500. Which one is higher? Easy. Until stock A is two standard deviations above its recent mean, while stock B is below its own average. The $500 stock has the bigger price tag, but the $25 stock may be in the more extreme position. Stay to the end because the biggest trap is not a bad formula. It is a perfect formula fed unadjusted data after a stock split. Imagine you are building a cross-asset screener. Your product manager says, just normalize the prices. That sounds simple. Unfortunately, normalize is not one magic button, and it is definitely not a financial smoothie setting. A raw price is like a street address. It tells you where something is, but not how far it is from home, the city center, or yesterday's starting point. A normalized metric adds the reference. Without the reference, normalized price is incomplete. It might ask, how unusual is price versus its recent average? Where is it inside its recent range? How far has it moved from a starting value? How has it performed versus a benchmark? Or how large is volatility relative to price? Different question, different formula. For a z-score normalized price, take the current price, subtract the rolling mean, then divide by the rolling population standard deviation. With prices 96, 98, 100, 102, and 104, the mean is 100 and the standard deviation is about 2.83. The latest price therefore has a z-score of about 1.41, roughly 1.4 rolling standard deviations above its 5 observation mean. Zero means price equals the rolling mean. Positive means above it, negative means below it. But z equals 2 does not mean the price doubled, and a large positive value is not a built-in sell signal. The metric describes position. It does not predict the next candle. Sorry, crystal ball department. The same price can receive different z-scores under 10, 20, and 100 period windows. Yet adding the same constant to every price, or multiplying every price by the same positive factor, leaves the z-score unchanged. The reference window changes the story. The currency scale does not. Another metric, normalized price range, asks a different question. Where does the current close sit inside the recent high-low span? Subtract the lowest low from the close, then divide by the highest high minus the lowest low. A value of 0 means the bottom of the range, 0.5 means halfway, and 1 means the top. 0.75 is not a 75% chance of going up. It is just location inside the observed range. Other normalizations answer other questions. Base 100 rebases every series to the same starting point. 50 rising to 60 becomes 120, or 20% above the base. Price relative compares an asset with a synchronized benchmark. Normalized ATR expresses average true range as a percentage of price. PPO expresses the fast versus slow moving average spread as a percentage of the slow average. Same word, normalized, 4 different jobs. Log price is related, but it is not automatically normalization. It compresses multiplicative differences and supports log returns, yet it does not by itself place price around a mean, range, benchmark, or base. Now the engineering part. A formula is only one line of the contract. You must also declare the input field, window, whether the current observation is included, population or sample deviation, warm-up behavior, zero-denominator policy, missing data rules, and price adjustment basis. The short name is not the algorithm. Let us open the actual FinTech builder page for normalized price range and use the site as the map, not as a static advertisement. Start at the title and the inside this build navigation. The page separates the article, workflows, references, implementation, and playground, so the viewer can move from intuition to evidence and then to executable code. Scroll to the useful intuition and highlight the practical question. Where does close sit inside the recent high-low span on a 0 to 1 scale? Then move to freeze the selected convention and box the exact formula. This is the moment the name becomes reproducible. Next, highlight the verification contract, required evidence, output clock, invalid states, and interpretation boundary. Then show the calculation steps, declare, validate, and build causal intermediates. Calculate without display rounding, emit diagnostics, and interpret the measurement rather than inventing a story. Continue to the guided lab, where canonical, boundary, and failure scenarios can be stepped through. Then show the tests, the TypeScript and Python implementation tabs, and the playground. The page is designed to expose behavior, not hide it behind one polished chart. At the bottom, highlight the related builds. That becomes your watch next map. Normalized ATR for cross-asset volatility, price relative for benchmark performance, Z-score normalization for unusual position, and PPO for percentage moving average spread. Here is where two platforms can display the same indicator name and still disagree. One may use close, another typical price. One includes the current bar, another uses prior only history. Windows, warm-up, equality, resets, and adjustment rules may differ. Do not compare screenshots, compare contracts. And now the kicker. Suppose a stock trades near $100, then completes a 2-for-1 split and opens near 50. If pre-split and post-split prices are mixed without adjustment, a perfectly coded normalized metric can scream historic extreme, but economically, the investor may have twice as many shares at roughly half the price. Adjust the historical basis consistently, and the fake shock disappears. Correct arithmetic on inconsistent data is still wrong. So before using any normalized price, ask, what exactly is being normalized? Against which reference? Over what window? What is the unit and output range? What happens during warm-up or a zero denominator? Are prices adjusted consistently? And is the result merely descriptive, or has predictive usefulness been tested separately? Then choose your next question. Unusual versus the mean, location inside the range, volatility relative to price, or performance versus a benchmark. Continue with that video on the FinTech Builder, because the best indicator is not the one with the coolest name. It is the one whose contract answers your actual question. Continue with Normalized Price Range. Source code and the complete learning path are at thefintechbuilder.com.